Cash flow or income statement? Which one should you use? I know it's hard to just decide what to use between the two. Just don't go over a snap decision, because here I am to help you answer that question. In this video, I will be sharing with you an in-depth comparison of cash flow and income statements so you can choose after you watch this. So make sure to stay tuned and take some notes while watching. So let's get started. Cash flow statement or income statement. Since a cash flow statement gives you a different set of facts than an income statement does, the one you use will depend on the financial decision you need to make. An updated set of financial statements, including an income statement and a cash flow statement, have been provided to you by your accountant. Financial statements serve several goals, one of which is to give you the owner or management pertinent data on which to base critical company choices. However, which statement you choose will depend on the choice you have to make, because a cash flow statement gives you a different set of data than an income statement does. An income statement that displays a good net income, yet the company does not have the cash flow to keep running, is a common issue for small firms. The amount of money that actually enters and exits a business over a given period is known as the cash flow. Net income is the business's profit or loss after deducting all costs from its entire revenue. But first, let's talk about cash flow. What is a cash flow statement? The cash flow statement helps in summarizing an organization's overall inflow and outflow of cash and cash equivalents. The financial statement's primary goal is to demonstrate an organization's liquidity and solvency situation. It is useful to evaluate a company's ability to produce enough cash to pay off debts and cover operational costs. Each business creates a cash flow statement in the conclusion of the fiscal year. The statement of cash flow includes all cash flows, not only revenue and expenses, unlike the income and expense statement. Cash inflows might include the revenues from new loans and cash from the sale of capital assets, whereas cash outflows can include things like debt repayment and the whole cost of purchasing new capital assets. A balance sheet's cash movements are reconciled using this statement. You can gain a better understanding of your company's ability to repay term obligations on time from the statement of cash flows. The replacement margin and capital debt repayment capacity are two ratios that are useful in this field. This assertion has three primary components, which we will go over below. First, cash flow from operating activities. A company's operating activities include bringing in goods and services to market in order to sell them. The cash flow that results from these operations represents an organization's net profit from selling its goods. Items that fall under operating operations include revenue, rent payments, and the indirect methods are both used to determine the cash flow from operating operations. Second, cash flow from investing activities. Using this method, you can figure out how much money you'll make when you sell or acquire investments and assets, and when you get interested in dividends or rent. Third, cash flow from financing activities. The cash flow from financing activities helps to examine the overall proceeds received by a company from shares, debentures, and other borrowings, while subtracting the outflows brought on by interest and dividend payments, debt repayments, and stock repurchases. What are the types of cash flow? Number 1, operating cash flow. The net cash a corporation generates through its regular business operations. Positive cash flow is essential for maintaining business growth in organizations that are actively growing and expanding. Number 2, investing cash flow. The term investing cash flow refers to the net cash made available by a company's investment-related operations, such as purchases of securities, purchases of tangible assets like property or equipment, or sales of assets. These figures will frequently be negative in strong corporations that actively invest in their enterprises. Number 3, financing cash flow. This especially relates to how money is transferred between a business and its shareholders, owners, or creditors. It is the net cash made available to finance the business and could come from dividends, debt, or equity. Here are the key features of cash flow. Number 1, displays the changes in the amount of money. Number 2, throughout a long length of time, that is 1 year, 1 quarter, year to date, and more. 3, violates accrual accounting rules in order to display just cash movement. 4, consists of 3 parts: cash used for operations, cash used for investments, and cash used for financing. And 5, from the beginning to the end of the term, it displays the net change in the cash balance. What is the purpose of cash flow? The goal of a cash flow statement, as opposed to an income statement, is to display how much money your company makes, sometimes referred to as cash inflows, and how much money it spends, known as cash outflows. A direct cash flow statement and an indirect cash flow statement are the two different kinds of cash flow statements. The method used to compute cash flows from operating operations is the primary distinction between the two types of statements, the indirect approach, the direct method approach. More results for businesses that employ accrual accounting. The indirect technique involves changes to change data from an accrual basis to a cash basis. Now that you know what cash flow is, let's talk about income statements now. What is an income statement? One of the company's most crucial financial statements is the income statement. It serves as a gauge for an organization's overall profit or loss for a certain accounting year. The whole revenue is first computed and the total expenses for both operational and non-operating operations are then subtracted to get the profit or loss. The income statement is one of the most important financial records that gives stakeholders a comprehensive understanding of a company's present status according to many businesses throughout the world. Items like gross profit, net profit, taxes paid, revenue, costs, selling and administrative expenses, etc. are all included in the income statement. For the simple reason that the most which the company constructs its financial report, the majority of agricultural operations create their income and expense statements annually due to the seasonal nature of their operations. You might imagine the income and expense statement as presenting the tale of what happened during the year, while the balance sheet is a snapshot at the start and conclusion when considering how an income and expense statement fits with a balance sheet. What are the types of income? Number 1, gross profit is the difference between revenue and the cost of products sold. It contains variable costs such as the cost of materials and labor directly related to creating the product, which depends on the amount of output. It excludes other fixed expenditures such as rent and employee salaries, which are not directly involved in the production of goods, which a business must cover regardless of output. Number 2, operating profit. Like operating cash flow, operating profit exclusively refers to the net profit generated by a company's regular business operations. Negative cash flow, like tax payments or loan interest payments, are often excluded. The same holds true for positive cash flows from sources outside of the core business. Earnings from interest and tax is another name for it, EBIT. Number 3, net profit. This is the amount left over after all costs and revenues have been subtracted. This often covers costs like tax and interest payments. Here are the key features of income. Number 1, displays of business income and costs. Number 2, throughout a long length of time, that is 1 year, 1 quarter, year to date, and more. Number 3, uses accruals and matching as accounting concepts to depict numbers not presented on a cash basis. 4, utilized to evaluate profitability. What is the purpose of an income statement? The purpose of the income statement is to display the amount of profit generated by your company during the particular reporting period covered by the statement. A single-step income statement and a multi-step income statement are the two formats available for income statements, and the one your company chooses will depend on your business's structure and the type of information you require for decision-making. Partnerships and sole proprietorships are the most typical users of the one-step income statement. It is a condensed statement that concentrates on a company's net income or bottom line, which is calculated by adding up all of the revenue and gains for the company and deducting all of the expenses and losses from this total to get at a net income figure. While the various revenues, gains, and expenses, as well as losses, may all be broken down in a single-step income statement, the information is less in-depth. Entities with a more complex business structure, such as corporations, employ a multi-step income statement, a more extensive income statement format. This style gives customers a thorough overview of both revenues and gains as well as expenses and losses, and it doesn't just concentrate on a company's net income. The multi-step income statement also shows consumers the company's operating income and gross profit, which are calculated by deducting the costs of items sold from net sales obtained by subtracting operating expenses from gross profit. Key differences between income statement and cash flow statement. Regarding the distinction between the income statement and cash flow, the following points are significant. Number 1, an income statement is based on an accrual basis, due or received, whereas the cash flow statement is based on the actual receipt and payment of cash. This is the main distinction between an income statement and a cash flow statement. Number 2, while the cash flow statement is broken down into 3 categories, these are operating, investing, and financing. On the other hand, the income statement is divided into 2 primary categories. These are operating and non-operating. Number 3, while the cash flow statement is beneficial for understanding the business's liquidity and solvency, which influence present and future cash flows. The income statement is helpful in determining the company profitability. Number 4, a financial year's worth of income and expenses are taken into account in the income statement, which is based on the accrual system of accounting. The cash flow statement, on the other hand, is based on the cash system of accounting, which solely takes into account actual cash inflows and outflows throughout a given fiscal year. Number 5, various records and ledger accounts are taken into account in the income statement. Contrarily, the balance sheet and income statement are taken into consideration while creating the cash flow statement. Number 6, depreciation is taken into account in the income statement, but since it is non-cash item, it is not included in the cash flow statement. For all commercial organizations, creating an income statement and a cash flow statement is a requirement. The two statements are used by readers of financial statements, stakeholders such as creditors, investors, suppliers, competitors, employees, and other teams to learn about the performance, stability, and solvency position of the organization. These declarations are also used for internal and tax auditing purposes. Which statement should you use? You should consult your company's income statement if the decision you're making has to do with the profitability of your enterprise. For instance, if you're trying to determine whether you're making a profit or a loss. However, the cash flow statement will be more useful if the choice you need to make has to do with, for instance, the amount of debt your organization may responsibly incur. Only two of the most important tools for managing your organization are the cash flow statement and the income statement. Reach out to your accounting team or other experts to ensure that you have the financial and operational data you require in an easily accessible format. To provide you with more peace of mind, you can also employ an online service provider to help you with the creation of management and compliance-related documents, such as yearly reports. It's critical to realize that even if the income statement and cash flow have certain differences, both are crucial for any corporate organization. These two financial statements must be prepared by a company in order to reflect its position and economic activity throughout the course of a fiscal year. Should you use both of them? Even though each financial document is a helpful tool on its own, when combined, they offer substantial information. Using data from all financial statements, additional ratios pertaining to financial efficiency can be derived. Asset turnover rate, operating expense, depreciation expenses. All of the ratios and indicators work to identify areas of strength and vulnerability when used together. In fact, they might even assist us to keep things from going south. Which is more important, cash flow or income? Investors and business owners frequently look for a single statistic to assess a company's health. To decide whether to make an investment or change their business plan, they desire one line item on a financial statement. These situations frequently put cash flow and profit against one another. Which is more significant, though? That question doesn't have an easy solution because both profit and cash flow are significant in their own right. If you wish to assess the financial health of a company as an investor, business owner, employee, or entrepreneur, you must comprehend both metrics and how they relate to one another. For instance, a business may be successful while yet experiencing negative cash flow that limits its capacity to cover expenses, grow, and expand. Similar to how many startups and scaling firms fail to turn a profit, it is feasible for a business to have positive cash flow and rising sales. To make wise business decisions, you should be fluent in dozens of financial terms, metrics, and ratios, of which profit and cash flow are just two examples. It is possible to improve professionally and become a wiser investor or business owner by developing a full understanding of fundamental financial concepts. So, what do you think of this in-depth comparison between cash flow and income statement? What are your thoughts about these? Should you use cash flow or income? Why not tell us in the comments below? We'd love to hear from you. Also, check out more of our videos about your financial journey on this channel. Don't forget to click that subscribe button, ring that notification bell, and hit the like and share this video with your money and business-minded friends. Until next time.